woke up Monday feeling bold and brave. Saw the markets rising, had to catch that wave. Bought all my stock at the tippy top, didn't know the tide was about to drop. I buy high, sell low, watching all my money go. Should've held tight, let it grow, but I panicked, sold it in the undertow. Now I'm sitting here without any dough. Retirement's a dream I won't know. They said just dollar cost, don't time the tide. But I saw green candles and I lost my mind. Sold it in a dip when the fear took hold. Locked in the loss, now my dreams feel cold. I buy high, sell low, timing markets like a rodeo. Should've stayed calm, gone with the flow, but I dumped it all when it started to blow. Now I'm back on Reddit, feeling low. Can't retire, that much I know. If only I listened to Jack Bogle's voice. Stay the course, kid, that's the smarter choice. But like a moth to a flame, I was led. Now my portfolio's all in the red. I buy high, cry low, lost my gains in one bad show. Learned my lesson moving slow. No more panic when the candles go. Next time I'll chill, let compounding grow. And can quit my job and just go.
Well, the deal with AMD suggests that the AI spending is far from over for some companies. We're going to talk about that and maybe look ahead at some financials ahead of earnings and take your questions today on Open Interest. Hello, everybody, and welcome. And with a little more theme music this time. Over the weekend, we were playing around with what AI can do, and one of the things it can do is write songs. It's imperfect, but I think it gets the idea across with respect to trading. So for anybody who wasn't paying attention, and I'm guessing that most of you did, but if you weren't paying attention, why don't we take a quick peek at AMD today. And let's actually pull up a chart that just goes for 20 days or so. And by the way, to the producers, I've got something on the upper right-hand corner that I'm not sure what that clock is supposed to be telling me. But, okay, so what do we have here? Stock is up almost 35% in 20 trading days. Why is that? They announced a deal with OpenAI that is going to be good for $100 billion in revenues, supposedly. And that is a big number when you consider that this is a company that hasn't done $30 billion in revenues over the course of the over the trailing 12 months. And I haven't had the opportunity to really get into this to fully understand just how that money is supposed to come and so on. But the stock obviously up quite sharply. We actually have a position in AMD on the yield max side. And actually, first of all, we have AMDY is the covered call ETF that tracks AMD. And obviously, under normal circumstances, if you get some kind of a huge move, one of the things that you would not normally want to have done ahead of time is sell covered calls. However, one of the things that we have taken to doing more often is instead of just selling covered calls, we sell call spreads. And consequently, of course, we're going to sacrifice some of the potential gains, but the idea is that you reduce the amount of premium you're collecting and still get to participate in the upside in those circumstances if and when you get news out of left field, which I think we can say this is, as far as the street is concerned. If it wasn't, you wouldn't get the kind of rally that you saw today. And consequently, interestingly enough, this is the covered call ETF. That thing was up almost 20% today. So we did sacrifice a little bit of upside being short the call spread. So I'm not, doing that to pat the trading team on the back or anything like that, but actually just as sort of a public service announcement of sorts, because I am generally in favor of entering into trades that have positive theta if you can, especially as implied volatility starts to rise. And I just thought that it happened to stand out as a good example of this that we happen to have been engaged in. Because had we simply been selling at the money calls, so I'm gonna guess that was probably 15 million bucks right there, that particular fund would have given up on if all it had done was just sell covered calls. So we have that. The other thing for us to take a look at, what do we have here? So if OpenAI keeps signing deals like that, will it force their hand to go public, or who is making the investment commit to? It's interesting. OpenAI doesn't seem. We've kind of seen this in the VC space recently anyhow, which is that it seems that private companies that are in the hottest sub-industries are not struggling to raise capital. And in fact, if anything, some people have said that this has been kind of unhealthy for the secondary capital markets, because a lot of companies that normally would have IPO'd did not do so because they had ready access to capital in the private markets, and in so doing, are able to, basically follow their own path a little bit longer. Having a publicly traded company has a lot of benefits, but it comes with plenty of baggage too. And for entrepreneurs whose companies are relatively young and they're still trying to sort some things out, if you can raise 10, 20 billion bucks in the private markets, that gives you a lot of runway to continue to operate with a little bit less transparency. And in some cases for startups, that's a desirable place to be. So a couple things, and I see this is partially because I think it's related to questions that I'm seeing more of, which is, people who are concerned about the market's valuations here, and I can understand why they would be, and might also be concerned that they have been seeing some increases in volatility, which is a warning sign I've hinted about, but I just want to also point out that October and November are periods when we tend or have had somewhat above average volatility that, some of that might just be a seasonal effect. But the first thing I would start to focus on is financials, and we're going to start getting some financials reporting earnings very soon. In fact, I think we're going to be getting when is JP Morgan reporting? Isn't that today, tomorrow, so this week? What do we got here? It's next week. Okay. So they're going to be reporting. Oh, I should remember that. That's my father's birthday. So they're going to be reporting next week. And I think this is really the kickoff. I am less interested, interestingly, in the results of JP Morgan, though. And I am more interested in the results that are going to be coming out of companies like Capital One. And that's not going to be for another week after that. Why am I more interested in Capital One? Well, there's this theme that we've been seeing that consumers, especially the bottom half, are struggling. And, this goes to things like auto loan delinquencies, things like that we've been seeing. And, one of the points that I have made from time to time in the past is that, very often it's the credit markets that begin to see distress before the equity markets do. So as we're trying to sort out whether or not, we could see a pause in, how the equity markets are doing, this is one of the places that I would keep my eye on. Look, I mean, the U.S. economy is 70% consumer, and if we're seeing a lot of consumer distress, where we're going to see that when the financials start to report is going to be in things like loss reserves, right? So Capital One has a big credit card business. Their demographics are not quite as good. I mean, depending on one's perspective, but the demographics are generally not as good as, say, JP Morgan is. And so it's going to be their comments in particular that I would be interested in when it comes to whether or not they're going to be setting aside more. They start talking about credit card delinquencies and things like this. And early last week, I think we alluded to this, we also saw some surveys which suggested that consumer spending going into the holidays was going to be lighter than usual. It kind of feels to me like we often get that, people try to budget ahead of time and then inevitably their budgets don't hold up. So I take that with a bit of a grain of salt, but the reason this is going to be important is because it's going to speak not to their intent, but to their capacity, right? So it'll be a better sense of what a certain segment of the population is actually capable of doing, regardless of what they say they will do. And I think that's kind of important. So I would just, urge people to try to keep an eye on that. All right, so with that, let's take a few questions here. So Ranjana Gupta, hi Mike, do you like silver right now? And if so, would you play it via the metal or a miner? Thanks. I do like it. In fact, I don't know whether I'd mentioned this before, but I often like to look at the relationship between silver and gold. Gold, obviously, on a tear. One interesting point. We talked about this, I believe, a week ago. Carter Worth had favored the miners to the metal on the gold side up until about 3-4 weeks ago, and then he said that he was, basically preferring instead the metal to the miners. One quick point about that, and that is that, one way to think about the valuation of natural resources companies is, of their reserves, right? So as gold prices and precious metal prices like silver increase, you have the benefit that if their other expenses are not increasing, that their margins can expand considerably. And that's one of the reasons why people often look to the miners and say, okay, they're a levered play on the metal. There's another thing to think about, of course, and that is that if they represent a discounted version of the reserves that are in the ground in their respective mines, then of course there is, you can kind of think of that like a form of book value, right? So in this case, we're just going back 1 year, and what we can see is that these two have tracked very much in line with one another, both up about 50% over the course of the last year. And if we go back a little bit further, so now we're going back 5 years, both up about 100%, round numbers. Now, most of that move has obviously come since late 2022. But I don't see any reason at this point not to continue to like either one of these. If you're thinking about playing these things with options, which I could understand because it has been on such a tear, one of the things that happens with commodities sometimes is that unlike equities, when equities rise, oftentimes you will see implied volatility fall. You might see realized volatility come in as well, but you might see implied volatility fall. That's not always the case with commodities. And sometimes they will have very symmetrical skew, meaning that calls and puts are sort of trading at equal premiums relative to the spot price. Sometimes you will see call skew. You'll definitely see that in some things like natural gas, where short-term supply and demand imbalances can create huge upside spikes. So one of the things you're going to notice here as we look at silver is that even as the price has risen to fresh highs, implied volatility has been creeping up. Now, normally, if you were looking at an equity, you would say, okay, well, what's the catalyst? Maybe earnings is coming up, except that silver doesn't have earnings per se. So this is a situation where I'm just going to get rid of the historical volatility here for a second. We're just going to look at the price. But you actually, before I get rid of that, just notice that the realized volatility has in fact been dropping, but implied volatility is creeping up with price. And so that might give us a situation where we can, potentially take, oops, I don't want the historical vol. I want price. There we go. So as you can see, since mid-late August, silver has gone up sharply. Implied volatility on silver has also gone up sharply. So the next question we want to say is, ask ourselves is, okay, well, where is it in a historical context? Is this very expensive for 3-month implied? Modestly expensive? Let's go back for basically most of the, post-coronavirus period. So let's go back to, say, April of, I want to throw that data out a little bit because I don't really think that that's that helpful in this context. So let me just go to mid-April and take a look at how 3-month implied has been. So the mean about 27 3/4. It's rounded up, call it 28.30 last. So it is above average. Well above average? Well, the standard deviation is 3, so it's not even one standard deviation above average. But it is up there a bit. And one of the other things we'd like to take a look at is the aforementioned skew. So we'll take a look at 3-month skew. So we've already established that at the money vol is a little elevated, and we have that big call skew that we were just talking about. Again, not that surprising. So I think maybe things like call spreads might be a way to play this for continued upside. And let's take a look at how one of those might shape up. If we wanted to look at, and by the way, like I said, you can continue to use the minors. I think that's a legitimate way to play it. But if we're just going to look for a pure play, I can't pull silver futures up on the options play app, so I'm just going to use SLV, which is what I was just charting anyway. And we'll go out about 3 months. So that's going to take us out to, just go out to, you could either go to the end of the year, December, maybe we just take a look at January. Just take the possibility that you might be able to retain. So what do we get here? All right. Now, if we took something like, now I'm going to look at an in-the-money call spread in this particular example. So let's look at, say, the 40. I just want to see how much extrinsic premium you're going to be spending. So this is only trading 70 cents over. So that's basically a push against the 51s. And you end up with something like this. So just notice here that rather than buying SLV, okay, you're going to put this trade on. You basically are paying out no extrinsic premium. And you have $4 worth of downside from today's closing price. And you have $7 worth of upside from today's closing price from now until January. And the reason you have that is because of that skew that I was just talking about. So the question you might ask yourself is, why would I rather own SLV than this trade? And don't forget that this trade also, there's a carry cost. You put up, $4,400 to buy the stock, to buy 100 shares of SLV right here. This trade, your outlay is going to be $400. So the carry cost is going to be essentially the interest on $3,600 over the course of the next 100 days. So let's say that your money market account will give you, for round numbers, we'll just say it's 4%. So that's $144 a year. This is about a third of a year. Just go 0.3 times that. So that's $43.20 right there. Right? So, I mean, effectively, you're getting this thing, relative to buying SLV, the underlying. To me, it seems like kind of a no-brainer that you would rather do this trade than that one at this point, especially given the big run we've had, right? So at this point, you do that trade. Now, your downside risk between now and January is limited to 10%. And like I said, you still have a $7 worth of potential upside. So there's a trade for you. Just something to think about when you get these types of situations. So one of the reasons why we like using put spreads when you're trying to hedge an index position as well, when the skew is really steep, because you can get these kind of favorable risk-reward relationships where you can make more than you might potentially lose otherwise. All right. So Jim Howard, hi Mike. Regarding economics, at what approximate date do you think panic may rise in the stock market with the government being shut down? Well, we've had prior shutdowns. I think in the first Trump administration, we can look this up. I don't remember exactly how long that shutdown was. So the Clinton administration had a 16-day shutdown here. There was a 35-day shutdown in 2018, 2019 during the first presidency of Donald Trump. And yeah, that's let's see when that period was. So that's 35-day shutdown started December 22nd, 2018. Well, that's interesting. The timing's a little bit difficult to talk about the implications there, because many of you may remember that the fourth quarter of 2018 is what's sometimes referred to as the taper tantrum, right? So this was the situation when the Fed was going to reduce their balance sheet, or at least reduce the pace at which they were adding to their balance sheet. It was not that they had just stopped purchasing and started selling securities. That's not what happened, but they reduced the pace. And the market didn't care for that one bit. Don't fight the Fed and all that. I think we may have even gotten into a formal bear market. Let's just double check that. But I think that was true. We'll just pull this up really quickly and take a look. That was the fourth, as I pointed out, that was the fourth quarter. I'm going to go into the tail end of the third. Let's see how big a drawdown we got in here. So that high was actually in September. So it was right here. Just shy of a formal, on the closing basis, just shy. So kind of like the tantrum that the markets had this year, post-Liberation Day, probably hit an intraday peak to trough decline of more than 20%, but not a close to close. But so that's an interesting time. So this is when the shutdown basically initiated 2 days prior. So it was on the 22nd, right here. And that one went for 35 days. So let's take a look at how the market did in that time frame, because that's when the Fed also decided that it wasn't going to be quite as hard-nosed about things. So that shutdown, I guess the Fed being the more important issue, so 35 days would take us right over to basically the end of January. Is that? Oops. Oh, this is not daily, is it? Oh, it is. Yeah, so the market's rallied 10% in that situation, and it certainly was pretty much gangbusters thereafter. I don't know that your question is necessarily about how equities will do, as much as it is about how the economy will do. But I do think, it obviously has some implications. The government spends quite a lot of money, but it's not as if everybody who works for the government, that they're just simply not going to be made whole. So I have a feeling that this is a little bit of a sort of squeezing of the balloon effect, where rather than, us just thinking, okay, well, this government spending isn't going to happen at all, to rather it is just going to be delayed somewhat, reduced a little and delayed somewhat. And also, I don't know that government spending has quite the same impact on the economy as private spending does. Economists differ on how much of an impact that makes, but safe to say the consensus is that $1 of government money spent is not the same as $1 of private money spent. So both delaying it rather than canceling it, and the fact that those dollars, as far as the economic benefits, are maybe a little bit less in combination, I'm not terribly concerned about it yet. I would add one other thing, which is, I'm not in the room with these folks, so I don't know who's going to cave. My sense of it is, though, that the Democrats probably should and will. And the reason for this is that regardless of one's opinion on how either party stands on the big issues, the Republican resolution was a clean resolution, meaning that they weren't asking for anything to have a continuing, basically for the government to continue to operate. It was the Democrats that said, we want some changes. We need the following things, or we're going to shut the government down. And I think, that's probably an okay position to take if the views you have are broadly supported by the public. But in this case, I'm not so sure that they are. Now, it's not my habit to try to wade into politically fraught issues too much. But I will say that the way this is positioned, so, the way the Republicans are framing this is about whether or not U.S. taxpayers should be paying, in part, this is what it's about, paying for the health care of illegal immigrants. Now, one of the things I keep seeing bandied about on this topic is it is already illegal, so therefore it's not happening. Well, of course, that's demonstrably false. In my state where I sit right now in California, Medi-Cal, which is the state's version of Medicaid. Medicaid is 50% funded at a minimum by federal reimbursement, and Medi-Cal admits illegal immigrants. So I can't speak to what's going on in every state. I'm sure it varies from one state to another. But what I can say is that this is a big issue in this state, because the folks in Sacramento announced that they were going to provide health care to illegal immigrants to great fanfare a couple of years ago. And, since that time, it has turned out to be a very costly exercise. And, Medi-Cal is partially funded by the feds, by federal tax dollars. And this is not popular. It's also, I think, whether it's, the final point I would make about this is it's also not affordable, right? So our entitlement programs are in real distress. Our government spending is a mess. The debt picture is a mess, but when people think about the debt, they're usually thinking about the outstanding amount of federal debt as if that's what we have to contend with. But the net present value of unfunded liabilities associated with entitlement programs is actually much, much larger. And this is, and I want to also point out, this is not just simply a partisan issue. I'm not, I'm actually a registered independent. This is not about supporting Democrats or Republicans, but this is not simply an issue that's coming from the Democrats. When George W. Bush was in office, they signed some changes into law specifically with respect to the drug benefits on Medicare at the time. And the net present value of that determination was also in the multiple tens of billions of dollars. So, this is, we can point the finger at a lot of people in Washington and say, you're not helping. This is coming as a surprise probably to very few people watching. But my guess is that because of this, the position, and look, a lot of it has to do with controlling the narrative, and, it definitely seems as if, there's a battle to do that, but I'm not so sure that at this point the Democrats are winning that particular battle of controlling the narrative on this one. So my expectation is that they probably are going to have to cave at some point. Maybe they won't. Maybe it's too much mud on their face to do that. So maybe that won't happen. But that's my sense of it. I would be surprised if this carries on as long as the last one did. Monday Morning Quarterback, nice theme song. Yeah, we're working on it. I'd like to use something other than canned stuff, and I don't want to have to pay for copy. I mean, it would be great if we could just have a jukebox over here and we could play whatever music we like, but that is both costly and results in copyright strikes, even if you have the rights sometimes, so we can't really do that. Okay, hi Mike. How will OpenAI pay AMD and Oracle for these recently announced commitments? Yeah, I think we touched on this one already. It's they don't have they're not lacking for access to capital. I don't think that's a challenge for them. Steve Garcia, there's a hilarious video on X of Moe, Curly, and Larry owing each other money and passing around the same $10 bill until everybody's square. It's a perfect spoof on NVIDIA, AMD, and OpenAI. Yeah, I sure wish we could do that with government spending too. But yes, there's a lot of money that just seems to be going around and around in these circles. I will say, one of the things that I like about this in general, though, is that one of the questions that a lot of people have asked is, when is there going to be an alternative to NVIDIA? I'm not suggesting that AMD is an alternative to NVIDIA. But what I am suggesting is that the story is not NVIDIA's alone. And that is good for AI, and it is good for other technology businesses, and it's good for consumers, frankly. We want to see some competition. We want to see some innovation. We want to see some different approaches that don't depend exclusively on a single supplier. So for me, I look at that and think of that as a positive. Jonathan Kwan, hello, good sir, and hello to you. And also from Steve Garcia, hello from sunny San Rafael. What do you think of my meta trade? Earnings are October 29th. DEACE 800 calls, long the DEACE 800 calls, and short the OX 680 puts. Positive theta trade. We like that. Let's put this one into options play so we can get a quick peek at this and everyone can look at it together. So you are long the DEACE 800s, and you are short, I think I got that right, the OCT 24th weekly 680s. So in general, I rather like risk reversals. I like positive theta trades. So I think that is all quite positive. I might think about pushing. One quick thing I would say is that when options get very short dated, and in several strategies, that YieldMax manages, for example, they sell a lot of short dated premium. But I will say that comes with, everything has a price. And the cost of using really short-dated options, the benefit is that they decay much more rapidly as a percentage of their own value than longer-dated options do. We all know that. But the downside is that shorter-dated options have more gamma, which means that the delta that they offer is itself much more volatile as a function of the underlying stock's price. So, that's sort of the risk-reward relationship. If you push this out just a little bit further, maybe out to, say, no regular, what you're going to observe now is that this is still positive theta, but you're collecting a much bigger percentage of the current stock price. So, is this really muting? I mean, it's a $700 stock. Right, so $26 worth of risk off the table, but now your risk is that you're going to be long the stock at 650 and change, 654-ish. If you just sold the put, we'll start with that, and that's pretty good discount to where the stock is currently trading. So I might think about pushing that a little bit further out. I don't mind the trade. I think it's a little bit of a matter of personal preference, whether you'd prefer to go a little bit further out in time and therefore mute the volatility of the position overall, take that gamma in a little bit. In this particular instance, so one of the things that also happens if you do it this way is that do you think this is the case going through earnings would be okay, though? I tried to avoid it. Yeah, so that's a good point. I mean, let's take a look at the volatility of Meta during earnings to get a better sense of that. I think that might be. So let's look for, here we have, you'll remember that we're still probably coming a little bit out of that metaverse swoon era a couple years ago, so I have to kind of throw that out. But why don't we take a look at this one here? So that was down 10.6%, right? So, and that's a fair concern, to be sure. So if we look at that would get you down to 643.5. And that's not an inconsiderable risk, but I kind of feel like these companies, and if you're going to have one of these businesses going through earnings, I sort of feel like this isn't really a bad one to have, because the cash flow is just so good with these things right now, and it's up to Mark to decide ultimately, and I think he's kind of come around on this. I feel like he's got a firm but steady hand on the tiller at this point. He's had ideas in the past. When it turned out that the street didn't like him and it didn't seem to be bearing fruit, he was willing to pivot and say, you know what, I was wrong about that. That's the kind of leadership you want to see. Not obscenely expensive. I mean, look at this thing. It's supposed to make $36 a year adjusted. Next year, trading $700. I mean, this with really pretty substantial growth rates. Now, could earnings throw a wrench in it? I suppose. But the other thing is, I would say, is would I be comfortable owning the stock here? And the short answer is yeah. So if you're comfortable owning the stock, then you should be comfortable selling the put. I wasn't really thinking too much about earnings. But one thing you could also think about doing is riding that into earnings and then repositioning directly out. But what I would probably consider is just pushing that out a little bit more in time. I just think I don't like to be short a ton of gamma if I can avoid it. So I kind of like getting short slightly longer dated stuff and then managing those trades once they get a couple weeks left on them, and those OCs they just get a little bit harder to manage And then you also can, I mean, for myself at least, it's easier also to start second guessing. You know, you're short a dollar cheap option. It's worth 1% of the stock price, maybe less. Do you hang on to it? You know, like that. So everybody's mileage may vary. That's kind of my 2 cents. But directionally, I like what you're doing. I like the use of the calendar. You know, something else you can consider is, is also using a strangle, so you have a calendar on the upside and short put. Oh, you said legging into a strangle. Oh, yeah, and exactly. See, I should have read your whole question. You even said that. Plan to leg into a strangle. Perfect. We're on the same page. So yeah, I like your trade. If you want to avoid earnings, stick with that expiration. Personally, I'd probably stretch it out a little bit more. Just my 2 cents. Okay. Oh, Jonathan Kwan. So I see your next question here about a theme song. You have, what did I just do with that? My son-in-law is a musician. What kind of theme song are you looking for? You know, we're trying to do something market related. You can see that's the one we played today had a little bit of, I guess, a country sort of a theme. We've experimented with some calypso, bluegrass. I don't know how pop would do, and I'm not really. It's not that I never enjoy a rap song, but it's not the type of thing I would probably put into a video. So, I think it probably would be, in that neighborhood. If you have any ideas, we're all ears, and so feel free to contribute your thoughts on that. So you are asking about Bitcoin and what do I see playing out going into the end of the year. I mean, I've said this many times. I'm one of the Bitcoin bulls. I'm basically a bull for anything that isn't the dollar, for all of the reasons I've previously discussed, which is that, you can't maintain the value of a dollar if you continue to borrow vast amounts of money. We don't have a sustainable fiscal policy. It's as simple as that. That's the unfortunate reality. And in other circumstances, maybe that wouldn't have mattered. But it seems like much of the world is coming around to that same point of view. And so people are adopting Bitcoin. They are adopting other cryptos. They are buying gold and silver. Central banks are buying them. It's a general trend. And I have to say, this is not a happy outcome. I don't want that to happen. I would like to see us with a strong and stable currency and good fiscal policy, but it's not up to me or up to probably any of you watching, and it's a frustrating circumstance. But for as long as that's the case, almost any other asset is preferable. That's the harsh reality. Could be choppy, but I think it will continue. Where's Bitcoin right now? I think JP Morgan, was it over the weekend that they just raised their price target? I believe so. Was it 135 for the end of the year? 140,000. Where's JP Morgan's price target? I'm pretty sure I saw that over the weekend. 165,000. What was I saying? 135,000. 165,000 is JP Morgan's year-end price target now. And it's this debasement trade. And the debasement trade, what's going to accelerate Bitcoin's appreciation is the degree to which sort of everybody comes to the same point of view about it. But, the more people believe it, the more people who don't will believe it, and it's become self-fulfilling. Because the dollar itself is largely built on faith. It's the full faith and credit of the United States government, but people are getting a little concerned about that. So, yeah, I continue to be bullish there. Tucker D Dog, with auto loan defaults increasing, FICO adding BNPL. Oh, yeah. So FICO buy now, pay later. These, I think we alluded to this last Wednesday, that a number of the buy now, pay later companies were pretty hard hit early last week. Let's take a look. How did a firm do since then? So even as the market's hitting these fresh highs, yeah, it's down almost 16% in the last 10 trading days. It got caught a little bit of a bounce today. The issue with this hitting the FICO score is it's going to affect the amount of accessible credit that a lot of these consumers have. Now, I've never used one of these buy now, pay later services, but it seems like they show up on every e-commerce checkout these days. You can choose this. And I could be wrong on this, but I also kind of, I don't pay much attention to them because I don't use them. But is it true, somebody please chime in and let me know, but isn't it true that some of these are trying to incent people to do it by saying, if you buy now and pay later, we'll do low or no interest or something like that? I don't know. If somebody knows more about that, please chime in. Yeah, but I for some reason, I kind of recall that they were offering these kinds of incentives for people to use them. To me, if that's why people are using them, like, look, I'm being offered credit and I don't have to pay for it, that's a sensible economic choice. If somebody says, okay, well, you can pay right now or you can pay me over the course of the next 30 days and pay no interest, or maybe in some cases even longer. So, for example, if somebody says, look, I'll let you buy it now and pay it over the next 12 months without interest, I'm not exactly sure how that's a business. I wouldn't want to be in that business myself, but I could completely understand why a consumer would take advantage of that if they were given such an offer. So I'd be very curious to know whether you guys have more credit on that. But adding it, yeah. Yeah, I mean, it's my understanding, and I'm also being told that a good percentage of those who use those services are late. That's a little bit troubling. I do think it should go into the FICO score. And yeah, I mean, if it goes into the FICO score, then, as I said before, people's ability to extend or expand their existing lines of credit to continue to spend, if they're spending beyond their means, is going to be challenged. So, Jonathan Kwan, smash the like button. Yeah, absolutely. By all means, we appreciate it. Thank you. So, Steve Garcia, do you think in this case going through earnings would be okay, though? Oh, yeah, okay, so sorry. This is related to your Meta question. I think I've given my answer on that. If one were to choose to sell options on MSTU, okay, 41% of buy now, pay later users say they paid late in the past year, up from 34% the previous year, according to LendingTree. Well, that's not a good trend. And that's consistent with a lot of the other things that we're seeing in consumer credit. And I'm not surprised. We salaries have not kept pace with inflation. And consequently, people are going to be pinched. Some things are discretionary, some things are not. And people are going to, if they need to get certain things, they will get them by whatever means they can, including borrowing money to do so. I used to track this. I haven't tracked it as much. Payday loans. So I should probably, I'll do that between now and Wednesday so I can get a better look at that. But I kind of remember that that was also an interesting kind of barometer. Okay, so Jonathan Kwan is saying, if one were to choose to sell options on MSTU, the 2X MSTR, how far out can you sell the strike before decay becomes a factor that impacts your trade? So, Jonathan Kwan, if I could just ask you this follow-up question. I'm assuming that what you are referring to then presumably is selling downside puts. And the reason I say that is because you're talking about decay, and I'm assuming what you are referring to is the decay embedded in the ETF itself. So if you don't mind just chiming in and clarifying that, I'm going to answer the question assuming that's what you meant. Okay, yeah, that makes sense. So a couple of things about this. First of all, one reason you might be thinking about using MSTU rather than MSTR is because MSTR is just a much higher dollar stock. So you have, when you're dealing with a lower dollar stock, you have more flexibility. You know, in one case, you're dealing with something that's trading just under $6. In the other case, you're dealing with something that's trading for $360. So when it comes to trading contracts and fine-tuning the amount of exposure you have, in that sense at least, MSTU might seem like it has somewhat better flexibility. But I do want to just bring something to everybody's attention. And this isn't just true for MSTU versus MSTR. This is just a general statement about trading options on derivative of something. So MSTU is itself a derivative of MSTR. It's a simple one. It's just simply a levered play, but it is a derivative. So now you're trading derivatives on derivatives. That's not necessarily a bad thing, but understand that the people who make markets in these products understand them very, very well. So they understand this relationship perfectly. So let's just take a look here. Now, is there some ebb and flow in the relationship of volatility of MSTU and MSTR? A little, but really not very much. This looks like a volatile chart, but it isn't. Check this out. The lowest number on this chart is 0.486, and the highest number on this chart is 0.54. This is the ratio of volatility on MSTR to MSTU. We could invert that, and it's going to be the opposite way around. It's going to be 2x, right? So what does that mean? Well, what it means is that the implied volatility of one should therefore also be a function of the other. And lo and behold, it is. Over here, 3-month implied got down to 0.41, MSTR versus MSTU, and up here, you know, it got up to, what do we have, 0.58. It might be a little bit on the high side here. But I guess what I'm saying is it's not like there's a free lunch here because the implied volatility on MSTU is double that on MSTR because it's double the volatility it should be. So that's one quick thing, because I've seen people do that, say, oh, you know, I could buy a call on a levered ETF. Well, or you could buy more calls on the underlying ETF. And the cost should work out to be about the same. So now let's go out, and let's just say, for the sake of argument, let's just go out. Today is the 6th. So we'll just go out to the 7th of November. We'll go 1 month out. And we'll look at the at-the-money puts. At-the-money puts in MicroStrategy are $25.50 in, again, round numbers. So 7% of MSTR. And in MSTU's case, we'll do the same. Actually, it's going to be a little bit harder because so this is 70 cents. Yeah, so because it's $half increments, I can't get quite at the money. 0.7, I'll do it over the strike. So 0.7 over 5.5 is 12.7% of MSTU. Excuse me, of the 550 strike. So what you're going to find is that it's not as if you're getting a higher rate of return by selling puts on MSTU than you are on MSTR. They are more expensive as a percentage of the underlying price because it's double the volatility, and it will reflect that. So I'm not saying that's good news or bad news. I guess it's not news at all. One thing I will say, though, is that as far as decay is concerned, which is the other point you bring up, the good news is that the markets are not clueless about that either. So usually in an efficient market, the prices will kind of get baked in the cake. So from my perspective, if you're thinking about using one or the other, MSTR options are going to trade tighter in percentage terms from bid to ask. They will be slightly more liquid. So in the event that something screwy starts happening, those markets are likely to get disrupted less. That said, if you are comfortable with the fact that this is over 100 vol, strategy is volatile enough as it is, but this is over 100 vol. If you're comfortable with that and you can get off a put sale in the middle of the market, I think that's fine. Just, it doesn't, and again, it does not matter whether you're talking about MSTU versus MSTR or any other levered ETF or inverse ETF versus some underlying. These markets are generally pretty efficiently priced. And once you recognize that, you might say to yourself, assuming there isn't a dollar cost issue, because I'm not going to deny that there's flexibility in being able to have a contract that in this case is, one synthetic in MSTU is $573 versus, a comparable synthetic in strategy, which is, a $360 stock, is going to be a heck of a lot more money. So, if you wanted to deploy $50,000 to a trade, you can do so with very fine increments in something like this. Not so much with strategy. But if that's the reason, worth noting, you could also trade, say, a one lot in strategy and then fill the balance out with these. And in so doing, you'd probably also get a little bit of experience with how these two behave relative to each other. Again, this is not a hugely widespread. I don't think it's an unreasonably widespread. These are options. Strategy is a derivative of Bitcoin. MSTU is a derivative of strategy. And now we're talking about options on that. So this is, we're now on to the third derivative at this point. 10 cents is not an unusually widespread, but it is almost 2% of the price of the underlying in MSTU. And if you were going to do a lot of these, then I would probably steer you in the direction of just trading the regular underlier strategy because the slippage is going to be less. So I hope that helps. Okay. Yeah, and actually that's also, and this is a point that's also worth noting, and that is that, many of these types of products do have a bit of decay in them associated with the fact that they employ leverage. But not all. I actually saw a couple of these levered ETFs, and I apologize because I should probably have committed it to memory, but I was looking at one of these things and I was saying, it's a 2x levered play on the S&P, and how has that thing performed over the course of time? And I looked at its total returns over a lengthy period, and it was indeed really close to 2x. I thought that was a really well-managed one, so maybe somebody can dig around and figure out which one this is. I'm not going to bother to do this right now. But I was surprised by how little decay it had. Maybe they got lucky here or there, but it was remarkable, I thought, actually, that they were able to attain essentially a 2x total rate of return over a lengthy period of time. Now, where you're going to see the roll costs really eat in is typically in things that have futures that have steep contango underlying. So USO, this is, and again, it's not a knock on the U.S. oil fund or the U.S. natural gas fund or any of these things. But the fact is that if you're trading an underlying commodity that has a really steep roll cost, that can be bad. It even worse are things that tend to trade the VIX futures curve, because the VIX futures curve is very steep, and this shape is persistent. So you buy a future, it rolls to the front, it's about to expire, you have to roll again, and you just beat yourself up over time. And the other thing is that you're paying a price for two reasons. There's a volatility risk premium here. The VIX is generally going to be at a level higher than realized volatility is, and you have this steep contango. It's just very tough to buy something like that and not suffer decay over time, and most of those products do suffer decay over time. Again, and I like to say this a lot, but it's worth repeating right now. I don't mean to impugn or denigrate anybody's investment products. Each has their time and place for the most part. I'm sure there are some that do deserve to be criticized, but I'm not going to get into that. But the options on these things typically bake that into the cake. If you look at the forwards on some of these exchange-traded products that have an embedded roll cost or decay, the forwards typically bake that in. So I wouldn't get too concerned in general about using options on those things, worried that you have to also figure that in. It's worth double-checking, but usually they price that stuff, in my experience, quite well. And that's because the people who trade them they're not going to leave an arbitrage sitting around for somebody else to pick up. All right, so we're rapidly approaching the hour, but we have a question here that I didn't get to. Steve is saying, can you please share your take on Uber as it hit a new all-time high today? Valuation is reasonable, if I'm not mistaken. I agree. I think that it is reasonable. And so this was the interesting thing. So you mentioned Lyft. I prefer all else equal to be in the best of breed, especially if the valuation is reasonable. It is here. It's hitting all those magic, it may seem really simple, but I'm a simple guy. So, I like to see companies to even consider them. I want them to grow faster than the S&P, top and bottom line. This one does. I want to see good free cash flow. This one has decent free cash flow. It's also growing at a decent pace. It is unlike the BJ's. Oh, I had mentioned BJ's Wholesale last week. Did I ever get to that? I hope it did. I meant to. I'm pretty sure I talked about it on Wednesday. But yeah, BJ's I thought is looking a little cheap relative to Costco. Same thing it did same time last year. Pretty sure we talked about that on Wednesday. In this case, it's not as if Uber's trading 50 times forward. Right? That's kind of the important thing. It's not even trading 25 times. It's trading cheaper than the S&P with faster growth. So in that case, I'd rather be in the best of breed one. The one that was kind of interesting in this space, this is not exactly the same thing. So Maple Bear, previously known as Instacart. So kind of interesting that you brought this up. This one is also trading quite cheap. Now, they are not the best of breed, and I have struggled to understand how these guys were going to compete with Uber and Lyft sort of nipping at their heels, and they're actually much bigger. It seemed like it would be a whole lot easier for them to get into this business than for Instacart to get into theirs. That said, Instacart did announce a strategic relationship last week, and I think it was, who were they teaming up with? This was not my name, but Michael Anthony. This market is over my head and don't understand why these companies go up so much. I don't know which ones to buy. Like I can pick the losers. Well, Michael Anthony, I think one of the names that you have, just knowing from your comments, you've brought up Pfizer many, many times, and that one did get a pop last week, or maybe it was the week before. But that one got a little bit of a boost once they signed that deal with the administration, which was going to give them a 3-year, basically free them up from tariff concerns for 3 years, and they were going to basically reduce costs that they were charging the government for certain drugs and so on. But I will tell you this, Mike, and this kind of goes to this question on the Uber thing. Actually, these are related. And I've brought this up before too. Don't go with the cigar butt strategy. Do not try to hunt for stocks to buy because they look cheap. Like they have a really low PE. Pfizer was down to 8, I think, at one point. But they were shrinking on the top line. And, they have plenty of secular problems. When a company is shrinking on the top line, that's a really difficult situation to get out of because a lot of times the costs are not so easy to ditch. And on top of that, they are at the exact same moment trying to fix whatever's broken so they can get their way back to growth. And sometimes that requires spending, which means that the situation only will actually get worse before it gets better. If it is something that is in secular decline, sometimes there's no way to fix that. Growth solves a lot of problems when you're long stocks. I'd much rather see somebody overpay, by 10, 15% for some company with the notion that they're just holding on to this thing indefinitely for 10 years, 15 years. By that time you're going to say, do I wish I had bought it cheaper? Do I wish I hadn't paid $1.15 for something that was probably worth $1 at the time? Yeah, obviously we'd always like to pay less for something rather than more if we can. But you've got to buy companies that are growing. And I just don't see why people are looking at companies that are not growing as fast as the S&P. And the reason is because buying the S&P is easy. You just buy SPY and go on with your life. The reason you're watching this and the reason you're out there trying to pick stocks is because you think that there might be something that somebody's missing. But I guarantee you the companies that they're missing are not the companies that aren't growing or are actually shrinking. No one's missed that, like, oh, gee, it's 8 PE, but, the company's going down the toilet. It's going down the toilet. That's it. Don't touch it. That's somebody else's problem. So Michael Anthony saying, I sold Pfizer since so much risk in the way RFK was going after the vaccine companies. Well, that's not the only thing. And their vaccine business, obviously, along with Moderna's, got annihilated. And I had not been enthusiastic about Pfizer. I did offer that the long-term calls in Pfizer look cheap. And the stock is also cheap. So I thought, okay, I'm willing to take a flyer on a speculative long there for that reason. Maybe buy some long-dated calls in the name. But as far as picking stocks are concerned, why don't we start with this as just a general rule for anybody who's struggling? If the company's revenues don't go faster than the S&P, I don't care. Forget it. Like, maybe some of those are good buys, but if you're struggling, start there. Don't buy companies that aren't growing as fast as the broad market. And that's a good first step. If you do that, you're not going to find yourself in, eventually, you might overpay here or there, but good free cash flow, good steady margins are growing. That's kind of the simple thing. I honestly, it's one of my screens. I'll show you. Actually, I'll show you what one of those screens looks like. So if I just go into the Russell right now, and it says, okay, you can take a look at whatever you want. One of the things I will look to is I'll go to the actuals here, and you see where it has these growth rates, revenue growth. And by the way, when it says what values worked higher, that means, last 12-month revenue growth was higher, right? So I look and I say, okay, fine. So this is the investable universe, 4.8%. Fine. I want something that's higher than that. And actually, I usually put 6 in here because I think I've said that the compound annual growth rate for S&P earnings growth, this is the Russell. Oh, no, I've got the S&P in here. And you know what is also interesting is that when you start going through this exercise, the same companies keep popping up. Lilly is in every screen. NVIDIA is in every screen. Broadcom shows up in every screen. You do. On a combination of, how do they look on valuation and how do they look on growth? But you end up narrowing the universe considerably. But you'll have enough to pick from if you just start there. And certain names just aren't going to show up. And my guess is a lot of those are the ones that have made you unhappy. So maybe that's where I'll leave it. Here's one other thing to think about before we go. I don't know whether we're going to be able to play that same song that we played at the beginning or some variant of it. But also think about this. Would you buy the stock if you could not sell it for 10 years? That's, I think, also a pretty good litmus test. If you're looking at a company and you said, here's the catch. Once you buy it, you own it for 10 years minimum. Would you buy Pfizer then? You know, would you buy some company that's not growing, that's basically been moribund for a decade, knowing that the value of a dollar is just going down over time? The answer is you would say no. You wouldn't do that. And the other thing I would say is just buy the S&P and then fiddle around with your stock picking outside of that. 20% of your portfolio, 30%. I don't really care what the number is. And then see how you perform against it. Am I buying stuff that's more volatile? But I think if you just start with, reasonable growth, that's going to be a really good first step. And the thing is, when you do that, and then you start looking for PEG ratios, say I want a PEG ratio of 2 or under, then the universe of stocks that you have to look at is going to become much smaller. And maybe we'll start looking at some smaller caps because that's probably going to be a lot more in there to choose from. Alrighty. I've chewed up more than an hour. As always, I appreciate it that you guys come in and listen to me babble on about this or that. And we'll be doing this again on Wednesday. And we're also scheduled to do office hours tomorrow with Mark Guthner. And he probably has some insights, in many cases, more valuable than any I can provide. So I encourage you to tune in for that as well. Like, subscribe, questions and comments. We welcome all of those. And we'll see you soon. Thanks for watching.